bright future. We're talking real money.
It's the show that tries to make it easier to manage your dough. I'm Don. Welcome to Talking Real Money, and joining me, as always, is my co-host Tom. And we really do want to help you better understand how this world of money works for and against you, and how you can make it work for you better. 855-935-TALK is our phone number, and we encourage you to call us on Saturdays to talk about the money issues that are important to you personally, because we want to answer those questions over those that we think should be answered. So give us a call, 855-935-TALK, 855-935-8255. We talk a lot about returns on the show. What the average annual return was for the S&P 500 or the Dow. No, we don't. We don't talk about the Dow. No, we try not to talk about the Dow. It's stupid.
Well, try not to.
It's
don't.
A stupid index. It's not even an index. It's an average.
Yeah.
But we talk about returns. We give you these numbers. We say things like, the market returned an average of 9% per year or 8% per year or 10% per year over whatever period of time. But there's another kind of return that we also talk about occasionally, and it's been studied by a lot of different people. It's called the investor return. And this is the return of real people in aggregate based on their actual trading of their securities in their portfolios. And Morningstar did a study called their Mind the Gap study.
Isn't that what they use in the underground when you're getting close to this? Mind the gap.
That's
right?
in that's in the
stepping
tube.
from the
that's
train
in the,
into the
yes. That's in the underground in London.
I thought I was right about
Mind
that.
the gap means
Mind the gap. Yeah.
Yeah.
Don't step down there.
Don't step between the train and the platform.
Yeah.
It's really bad for you.
It could be. This is about a gap that could be bad too. It's fascinating. Because Dalbar used to do this study, right?
I think they may still do.
They still do. Yeah. That looks at investor returns versus market returns. It's a fascinating thing. So according to Morningstar's Mind the Gap study, 10 years. Mm-hmm. 10 years of returns ending at the end of last year.
And again, this is just a snapshot. We don't think a 10-year return is indicative of much of anything.
No, but it is somewhat, and we'll talk about why
it's
in a
for
minute.
comparison purposes.
Yeah. 10 years. Dollar-weighted return, that's actual returns of these index funds, 8.2% on average. Pretty good 10 years. Yeah, right. Pretty bad if you're an investor in many ways.
Wait. No, that's the 8.2 is the annual total return.
That's what, total return
Not
of
the dollar
the
weighted. The dollar weighted.
The dollar
return.
weighted is the investors. I misspoke. You're right. Dollar weighted is how much you and I made as investors in those funds.
In aggregate, not each of us, but all of us on average.
Oh, no. I made like 20% a year.
Yeah,
I'm not supposed to talk about
we
that.
We did better. Well, actually, we did do better because we're some of the people who are boring and just leave it alone. But
or rebalance it, which makes you even more if you do it right. Anyway, okay, so thank you, Don, for average annual aggregate return 8.2. Mm-hmm. Investor return 7.0. That's a pretty substantial difference.
Yes, but it's better than it has been in the past.
That's true. But their study found, and I think this is important because, as you said, 10 years, nothing. The gap is persistent. They looked at 10-year periods 2020, 2021, 2022, and 2023 as well and found something very similar.
Yeah.
This has not just happened once. This continues to happen.
It's fluctuated between 1 and about 1.7%.
Number two, and this is where the money's rushing today into sector funds. If you buy and hold or trade whatever sector funds, according to them, you've done much worse because people have a tendency to buy and sell and do all that kind of things. Number three, the more you trade your account, I hope this doesn't surprise you, but it may, because you think, well, I got really smart. I got out before April, and then I got back in May after all the... Mm-hmm. Nah, you didn't. You did. Less money there, they say. The more trades, less money there. Number four, the funds in which there's style drift, which any actively managed fund...
Explain what that means.
Well, that means you bought what you thought was the S&P 500 fund, and then the manager woke up and said, well, nobody's going to make money there. I'm going to own these group of stocks instead. They changed their style. that provided lower returns, and funds. And again, this again shouldn't surprise funds that are more volatile, because people again tend to buy. And I think the ARC, right, would be one that would be on the volatile list.
Oh yeah, way volatile.
People tendency to get in, get out. All those things led to a 1.2% less in returns than the funds themselves.
And the lesson is, from all of these studies, you can't, in fact, you will likely underperform the market. Can't beat it.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more detail.
Your guides to a really great financial future. Tom and Don are talking real money.
You know that once in a while you get really befuddled and bemused by money. And that's why you have a resource every Saturday, every single Saturday. You can call us right here on our little program at 855-935-TALK. 855-935-8255.
I'd love it if you did.
Is somebody in the studio with you there?
Oh, there's all kinds of people wandering around the halls.
I hear
here.
somebody talking.
We're having all of our clients here today, so looking forward to seeing them.
Thing.
Well, not all of them. Yeah, they're all.
Some of them.
They're going to be out in the parking lot. Beautiful afternoon.
855-935-TALK. That's the number. Give us a call, just like Frank in St. Paul, Minnesota did. Hello, Frank.
Good evening, gentlemen. It's nice to get the weekly updates on the goings-on on the 405.
It's always nice
so
to know.
relevant.
It's always
So
nice to know
important.
how traffic is on the 405, isn't it?
How's traffic in the greater Minneapolis area today?
94 is partially shut down, but here in the Midwest, we don't refer to it as the 94. It's just 94.
Yeah.
Oh, okay.
Yeah.
Well, we're more special here. We just
It's
want
that West Coast thing. No,
It
it's
is,
like
yeah.
it's
The
the
5,
101. Yeah,
okay,
it's a California thing that snuck north.
Yeah, that's true.
It
That's a good
is.
point.
Anyway,
All
what's
right.
going on, Frank?
My question today has to do with, we'll call it the 403B,
Yeah.
which is a financial thing and not a highway.
Oh, I was going to
But
say, I haven't
have
been
some
stuck
general
on that one
questions
yet.
about
But
403Bs.
yes,
Okay.
sir.
Well, I know they're widely derided on this program, and I'm curious specifically, what is the problem with 403Bs? Is it the mutual funds they offer are not very good? They have high fees? Is it high fees for the plan, the administration itself? And could an employer who offers a 403B choose an operator that has a more friendly 401k-like structure?
Well, let me first answer that question by saying most of the 403Bs in America, particularly those that are sold to teachers, are a bee in my bonnet. Because
They're a D in my bonnet.
Yeah, the B, as in buzzing in my bonnet.
Oh,
the reason is that by and large, the default investment choice in 403Bs in this country, particularly for teachers, have been variable annuities, which have no place, in our opinion, in any kind of retirement plan whatsoever. The average fee for a variable annuity is about 3% per year.
Somebody opened the door at these school districts and let all the insurance companies wander in and take full advantage. I mean, that's the other point to all this, Frank, is teachers, while smart, hardworking, they're generally not money-oriented people. They're not around,
or they wouldn't taken a job. Wouldn't have taken a job in teaching. Right. My daughter was one. They make no money.
They're getting taken advantage of many, many times by insurance salesmen. And so, yeah, what you said, the third point is exactly right. If you use a good provider, and what's the website, Don? Isn't there a website where you go
I'm on it right now, 403B Wise. It's my favorite website for 403B investors. If you have a 403B, you're a teacher or a healthcare worker, and you want to see what options are available to you in your 403B, go to 403bwise.org and actually put in your plan.
Yeah.
They've already done the work on most of them. But, yeah, and the good ones have Fidelity or Vanguard or somebody like that offering low-cost products. The bad ones have, what are they called now? AIG,
whatever.
It used to be Valak, but I think it's just
Hancock.
AIG. All of those
There's a whole bunch
stupid
of them.
things.
So you're right. The structure in and of themselves is not bad. It is the investments and the companies providing those that generally are very poor.
I love 403Bs. I think they're a great tool. I just hate the way school districts have established them because they've succumbed to pressure from people who pitch products. As a matter of fact, one of the major teachers' unions sells annuities into 403B plans to make money for the union.
Shocking. Yeah. Does that help, Frank?
Yes, it does. Thank you very much, gentlemen.
You're very welcome, and thank you for the call, and be safe out there on the 94.
On to the 101 now.
No, that's the 101 is down in SoCal. Do you have a 101 up north?
Yeah, we have a 101.
Does the 101 come all the way up there?
No.
Is it the same 101?
No, it's not. Clearly.
Okay. You can pot Frank's.
I hope that's okay, down. Frank. Yeah, it's good. But no, it's different.
Yeah, so please, I don't get us wrong. Here's the thing: is sometimes you'll hear us say things.
Yep. So he thinks we're mad at all 403Bs. No, that's not it.
Do we hate all annuities? Not all.
No,
just most.
Especially the ones that are sold by insurance folks.
And let me explain to you. I think it is important to explain why we hate variable annuities in a qualified retirement plan like a 403B. Okay, yep. A qualified retirement plan like a 403B, the regular kind, not the Roth kind, the money grows tax-deferred in that account. Okay?
In other words, there's no taxation while markets are doing whatever they're doing.
That's correct.
Yeah.
A variable annuity is a type of product that because the insurance company lobbied for this, that because it's tied to insurance, a variable annuity, you can put money into a variable annuity outside of a retirement plan, and it can grow tax deferred.
Sound similar?
It's identical, basically.
Oh, and yet you pay
extra money for that tax deferral that you already have in a 403B.
Makes no sense.
It makes no sense. No. You're paying for something that isn't of benefit to you. Plus, you're paying for death benefits and things that you don't really need.
It's an insurance contract.
And the problem is it makes the people selling them a lot of money. So if you have a variable annuity in your 403B, you need to go to this website, 403bwise.org, and you need to look your school district or hospital or whatever it might be up and see what choices there that are within there. If you can find Vanguard or Fidelity, yay! Get out of what you are already in. Switch out. But here's the problem. Do not call the guy or gal with whom you're working currently with the variable annuity because they're trained to talk you out of this.
You think?
Because there's a huge cash incentive for them to keep you involved. You only want, if you go to 403bwise.org, you only want to use those resources, those programs that have what they call the green light. There are green lights, yellow lights, and red lights. Yellow lights aren't awful. Red lights are awful. Green lights are pretty darn good. They're better. Now, there are some green light options that even we don't like because some of the green light options are actively managed funds. So we would like to avoid actively managed funds in addition to avoiding the variable annuities.
Yeah, well, the annuities are worse, but
They're
yes,
worse.
They're because the expense, it's just no reason to own them in your retirement account or period for that matter, variable annuity. But yeah.
Yeah, and trust me, those fees make a big difference. If your average annuity, if you put $250 a month into a variable annuity in your 403b with 3% in fees, at the end of 35 years, you're going to have less than $200,000. If you're in an index fund, you're going to have almost $350,000.
You decide.
Yeah. 855-935-TALK is our phone number. We'll be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our phone number. That's 855-935-8255. Pick up that phone, give us a call. And if you don't, then go to talkingrealmoney.com and send in questions for future programs. Type them or speak them. Let's go to Covington, Washington. Now, Gabriel, welcome to the show.
Well, good afternoon, gentlemen. I had a tip from the gym. The guy told me just buy the S&P 500 and set on it. What do you think?
You know, in the biggest picture, it's okay. Here's the struggle with the S&P 500. It is only 500 stocks, and we'd rather see you own, let's say, for sake of argument, 10,000.
Or 9,000.
Okay. Part two is you're missing so many things. You're missing little companies. You're missing really basically value companies. You're missing the entire international market. Yeah, all that stuff. But here's the bigger problem I have with it today, because I'm going to talk about this when I talk to our clients here in a little bit. The S&P 500 today, right now, 3 stocks, and you can name them, make up 21% of the index. That would be NVIDIA, Microsoft, and Don's favorite, Apple. The guy, our client who's here today said, Don told me to get into Apple in the 1990s, and I've been in ever since. I said, well, okay, that worked out.
That was back in the day when I thought you could pick stocks.
So
my opinion changed.
Heavily concentrated. Instead, by the way, our portfolio, it's about 7.5% of your money's in those 3 stocks because you really don't want to be concentrated. But as Don said, if it was that or nothing, I'd pick that.
Let me tell you how easy it is, though. Let's just say you were thinking, I'm just going to buy the ETF at Vanguard, VOO. I'm going to buy the S&P 500 ETF at Vanguard, VOO.
3 basis points or whatever it is.
Yeah, it's really cheap. But for about the same money, just slightly more, but it's tiny fraction of 1%, you could buy VT, which would give you all the stocks in the world. Which would you rather have? The 500 in the U.S. or all of them on the whole planet? And it's just as easy to buy.
Gabriel?
What's the percentage of the VT compared to VOO?
Oh, lately, VOO has done better.
Lately. But historically,
the long haul, no.
No, and here's the thing. It's not about which does or will do better. The difference is how comfortable you're going to be when the market tanks, which it will do someday. That's one of the few things I can say, I guarantee it's going to go down. I guarantee it. It'll go down, and it'll go down
Probably
a lot someday.
Yep.
When it does that, your S&P 500, if it's all invested in the U.S. and the U.S. tanks a lot, well, it's going to go down like it did in 2008, almost 50%.
Yeah, well, 2000 through 2009, big zero instead of being diversified, and that saved you.
But that almost 50% in 1 year, whereas if you had been in a comparable globally diversified portfolio, your decline would have been half that. A little more, but a lot less.
That sounds better.
Yeah.
Well, thank you for the education, gentlemen.
You're welcome, sir.
That raises a great point.
Yeah.
Hey, what have you done for me lately?
Right.
Yeah.
And we are not saying that investing in the S&P 500 is a terrible thing. We see it in portfolios all the time, and if you have it, then we encourage you to get some other things to add some balance to that portfolio.
Some of my favorite companies are members of the Standard & Poor's 500.
Yes, and some great ones are not.
That's true. Just being killed. Silly.
Some of my best friends are in the S&P 500.
That's what I was trying to do.
I knew that's
that,
what you were going for. I knew that's what you were going for.
Yeah. Anyway,
but
as I said, if it's that or nothing, then that. That's
when it comes to investing, we are not just looking for the best performance. This is so hard for most investors to understand. That is not what we're going for, because when you go for that, you increase your risk. They go hand in hand. Higher potential returns mean higher potential declines when those happen. Now, overall, should you make money? Yeah. But we're talking about human nature and emotions. Are you going to sit tight, and we don't believe you will, by the way, if your portfolio declines by 50% in 1 year? Are you just going to take it and sit there and not move? Some won't. Most will
not. You're going to suffer from the gap. Generally, you're going to fall into it when you sell something at the wrong time.
Good point. This is the Gap episode, the Gap Hour, and you don't want to fall in that gap. Mind the gap, ladies and gentlemen. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Trying to get the whole process of dealing with money right, but particularly the investing part, because that's where there is so much horrible information and advice. Really bad. The majority of, I really believe the majority of financial information and advice is counterproductive.
It's self-serving, generally.
I think it's
dangerous. Expensive most of the time. Yeah, I think that's true.
And so it's hard to find somebody who's going to give you the straight scoop. And when you do, you should never leave them. Never let them go. Never.
Well, never. It's a long time.
All right. Okay. 855-935-TALK is the number to call those people, those that you think you can trust. We hope you can. Forever. And let's go to Utah now. Garrett, welcome to Talking Real Money.
Hi, guys. How are you?
Good. Thanks for calling. What's up?
Yeah, so to get the straight talk, as you're just talking about, and someone I can trust, me and my wife are about 15 years from retirement, and we've been discussing purchasing a secondary home to escape the fold of Utah when we're here in retirement. And figure you gentlemen have probably come across this in your paths, and I mean, is it as simple as, well, it's going to cost an extra $1 million, and we just put that in our plan and build an estate for an extra $1 million, or is there other stuff I should plan on that you guys can maybe provide some thoughts and guidance on?
Wow, that's a big question.
Wait, okay, I got to go back, though. You want to buy the second home now for then, or later for then?
No. Well, later, like in 10 years, so we can get it set. So retirement in 15, so buy it in 10. It'll take 2 to 3 years to build, so on and so forth. It's not longer.
So right? You're going to be a snowbird. Your plan is to be your plan is to be snowbirds.
Yes.
Okay.
Yes. Absolutely,
okay, so,
100%.
Yeah, but what you're asking is, should I go ahead and set aside the $1 million it's going to cost me to build this? Is that the question I'm getting?
That's what it sounded like.
No, the question I'm getting is there other things I should be considering besides, like this is part of our retirement plan? Should I just include additional expenses for property and taxes, and hopefully we have the mortgage close to paid off by 15 years, or is it really just planning that stuff out? Like we need $200,000 right now for our retirement as kind of plan, and now it needs to be $300,000 to have a second home. I mean,
I would do that first.
I'm not thinking about.
Yep, I would. You need the plan.
That's kind of what we're working backwards.
Yeah,
we have the plan right now without a second home. The plan right now without a second home is 220 is our withdrawal number when we retire, and so it's just is there something else I should be considering to adjust that?
220 in 15 years or 220 in today's dollars?
220 in today's dollars, and then we've done the Monte Carlo syndromes and so on to figure out what our nesting
that's going
to
be. Quite a bit more in 15 years. So
and so we want to have 5. I think it's 5.3 is what we need when we retire, and then doing the flexible 4% rule that you guys have talked about gets us to the 220 now. Estimated, adjusted for inflation and so on, gentlemen.
Well, then if you want to have $1 million second home in today's dollars, $1 million second home, you are going to need to up that $5 million by probably at least $1 million.
Maybe $1.5 million, actually, considering inflation and everything.
Yeah.
Yeah, that's what we're thinking. Like, we need to go from 5 to 7.
Yep, you need to go from 5 to 7. You really do. If you want to do both. And there's nothing wrong with doing both. It just requires a lot of money to do both. And the problem is that you have real estate that sits empty part of the year. That's the only downside.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more detail.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, I live in the land of snowbirds here in Central Florida.
You really
Celebration.
do. That's it. Other than Arizona.
When you go outside here in the summer, one, you die of heat. But
you don't see
two,
anybody.
You look around, there's no one here. Literally, Celebration goes empty in the summer, and then in the winter, it's packed with people.
Yeah.
It's hard enough to own one house for me. Or owning two and I did own two for a little while, and I had to stop.
That's true, you did.
It was hard.
Yeah. Okay, here's the thing about that. I think this is a great question, by the way, but Garrett was really checking about the money part. But
yeah, I know.
I would talk about if it was me, and this is something I consider when I quit working.
Oh, you're thinking Arizona. I know.
Yeah, I know I am. But I would never buy a place. I'm going to rent something maybe for a month or two, just go down and kind of hang out for a bit. Why do I need to own it? In today's world, you can rent anything anywhere.
Well, because
I don't want to own it.
Well, here's one of the reasons. Here's one of the reasons.
Yeah.
Because, and one of the reasons why we got the Airstream is so we can have our stuff there.
Yeah, I don't have. Furniture and a bed. I don't really care.
Yeah, that's true. You don't have any. I have to have a whole studio.
That's true. I can take the studio that you give me in a little
anywhere I go.
box.
I have a studio.
Yeah, so I would think I would probably try it first, then I would really think about it, because you mentioned something else. Not unlike Florida this time of year. Probably not that many people pining to go to sunny Scottsdale this time of year.
115?
Good Lord.
No.
Oh, yeah,
even if it is a dry heat.
Yeah, I don't care how dry it is. You're going to burn up. So I'd think it through.
Yeah. And if you have a question about anything money-oriented, please call us at 855-935-TALK, 855-935-8255. You can call us at that number every Saturday from noon to 2 Pacific time when we do a show in Seattle. And then that becomes a podcast the next week, so you can listen. And you can also stream us live on Saturdays, too, with all kinds of streaming apps or Northwest News Radio's app or whatever it might be. So call us, 855-935-TALK, or if you have a question you want to ask at a different time, go to TalkingRealMoney.com and then click on the contact form, and we will answer those questions like now.
Yeah, we got one from beautiful Pittsfeld, New Hampshire. I don't
even know where that is.
Nina writes us, "Hello, Tom and Don. Listening to your 72125 podcast, you two are discussing sections of the One Big Beautiful Act, and at minute 253, Tom said Social Security reduction, $6,000 for each person who's getting Social Security over the age of 65, and household of $12,000. I was under the impression it was for seniors over 65. I have not read nor heard that it's required to be collecting Social Security to receive this deduction. Can you please clarify?" Well, I was wrong. I thought because this is the conflation of all of this. Remember, they were going to get rid of any tax on Social Security?
Right.
This has nothing to do with Social Security.
Right.
If you're over the age of 65 and under the age of 69, which is ridiculous if you ask me. But anyway, if you are,
it's pandering.
Then you get it's 6,000 plus times 2, it's 12. So yes, you're right, Nina. I had it wrong. It's not about Social Security. It's simply a senior discount.
It's the $6,000 senior deduction.
A senior deduction. So I stand corrected, and for that I apologize.
And it doesn't even apply to me because I'm too darned old.
Yeah, you're already out the other end.
I'm out the other end.
You're so senior.
I missed it.
Senior.
Oh, I missed it. Dang it.
Sorry about that.
Look at that. It just ran right by me. I can't even run anymore. Well, I could, I guess, but I don't
You want another one?
Well,
another question?
Unless the show's over, unless we're out of time.
I'd like to open the windows and let the studio's literally like 103 degrees. It's warmer than it is outside your window.
But it's a dry heat.
Yeah. Jim writes us from Orlando, Florida. By the way, the last name is a famous tennis player who probably lives in Orlando,
Florida.
I won't say it.
Yeah, it could be over in Isleworth.
Yeah, I don't know. Hello there, Tom and Don. Many thanks for the great shows with such practical information. That's why I'm writing you to get some practical information. A little background.
I'm a rich tennis player.
He says he's married and got $4 million. Now, the guy that I was thinking of probably had more than $4 million, but I could a good chunk, maybe 50% of that in stocks and mutual funds, and then about 10% in bonds. Now that's mutual fund can hold bonds, by the way. It doesn't. Mutual fund is just.
He means equity funds, I think.
Security, yeah. Okay, 62 and retired. $1 million of the money is received last year from an insurance policy I no longer need. We have no children from the sale of my mom's house that I inherited. I can't decide if it's the insurance policy or the inherited house. Whatever. We want this money to go 100% in stocks. That's my question. Where should I invest this money? $1 million.
What is the very best investment right now?
This moment.
Yeah, right.
Yeah.
That is, by the way,
$1 million. That's the question.
Popular question ever. I have some money. Where shall I put it?
Yeah. We don't get as much as we used to. We used to get it a lot more.
Well, that's because people have learned. But you've got the question before the question.
Yeah. Thank you. Well, no, he says don't need the money, 10 years at least, et cetera, et cetera. So that's
but still,
a little bit, but still, right. What's the purpose?
And we need to look at the other monies and where they are and how they're invested.
But if you were going to pick one thing right now.
If I was going to pick one equity thing right now, it would be
Altria.
AVGE or DFAW.
I'd pick Altria. I didn't know it was the best performer since 1925. That's got to hold up, right? Look how many young people are taking up smoking these days. A lot.
Do they still sell cigarettes? I don't even know if Altria's.
I haven't seen anyone. I saw it on a TV show the other night. I'm like, wow, there's somebody who smokes cigarettes.
Look at
that's really crazy.
The headline of their website is Altria.
Is what?
Moving beyond smoking.
Okay. Chewing tobacco or something? I mean, that's not a whole lot better for you, I don't think. So, wow, that's just. But the thing is, if you've decided the money's long term, it doesn't matter, by the way, if you're 15 or 85, and you're not going to be touching it for a long time. We're still going to say a globally diversified portfolio of some big companies and some small ones, some growth companies and some value companies. Make sure you got international in there and emerging markets. And that's it. Yeah. There's no really picking Altria or Apple or Nvidia or who's the fourth one? I forget on the quiz.
Apple, Altria, Coke.
Coca-Cola, which I don't think has been a great return lately, but I could be wrong because it's right. I read once that things really do go better with Coke. So
we don't pay attention to individual stocks that closely.
Sorry to say.
We really don't.
I used to when I had the TV show because I had to, but
I don't know where this next call is from. I don't even know this place. Maybe it's not. I've never heard of a Copalis Beach.
Copalis Beach, sure.
Copalis Beach. See, I would have pronounced that wrong.
I think that's right.
All right. Lori, welcome to Talking Real Money.
Did I get it right, Lori?
Hey. Yeah, it's Copalis Beach. You got it.
That's it. Retirement. Thanks, Gone. Good luck.
All right. What you got for us in a really short period of time?
Okay. I really like your idea about going, adding balance and diversifying and going to more global stock, position. I thought you said VT was something you liked.
Yep, VT, Vanguard Total Stock. Yep.
Vanguard Total Stock, okay. Anyway, I have been very, very heavily invested in the Apple, Intel, Microsoft, and then got NVIDIA from my father's passing before anyone had ever heard of what it was, and that's been very good to me. How in the world do I just have to sell this to do this? Because I'm thinking the capital gains are going to be prohibitive.
Yeah, that is the real
There's
problem.
a problem. Yeah.
Yeah, what you're going to need to do is sit down and do some tax planning. You want to gradually sell so that you don't kick yourself into the next higher tax bracket. So you just need to do a little tax planning. Sit down and figure out your tax situation, how much you can sell every year, and then gradually diversify.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
As we said, we don't pay a lot of attention to individual companies. So when we, in a previous hour, we talked about Altria and how well it had done over the past century.
Yeah,
but
100 years.
Honestly, I haven't paid that much attention to Altria since they spun off Kraft, because for a while they were more of a food company than a tobacco company. Well, they've gone all in with sin. They have just gone all in with sin now.
What else
they
are they doing?
are a tobacco company, basically. Yeah. They are. Their main business is puffing it or sticking it between your cheek and gum. It's one of those. That is Altria with they have nicotine pouches, they have vaping, they have all that. With a little investment, these aren't entirely owned subsidiaries of Altria, but they have major investments in two other companies.
And?
AB InBev.
Beer,
alcohol.
Yeah. Okay, which goes together well with tobacco.
And they own 45% of the Kronos Group. Do you know the Kronos Group?
Yeah, I know the name, but I don't remember why.
They're the one of the top cannabis companies in the world.
Huh. They're right. They're all in on sin.
Smoke
I like that.
them one way if you got them.
That should be their kick line.
Drink them if you
all
don't.
All in on sin. I like that.
Well, that's why their slogan is moving beyond smoking. So we're feeding
Stay stoned and you'll need alcohol. I don't know. So it's something. Program note. Program note.
Sin. There's a program note.
Yeah. As Eric Carmen once sang, next week I'll be all by myself, so call.
You're really going to do it by yourself? You're not going to bring in a guest host?
No, I don't think so.
When did you get so brave?
So. I don't know.
You usually bring
There's another
a guest
word
host
for that. I know.
All right.
I'm doing it. So let's see what
happens. So you
happens.
guys better call Tom. I'm going to feel guilty if you don't call him.
Maybe that's what I'm looking for.
Yeah, that's probably
so let's reverse that a little bit instead of me feeling bad.
I am taking a brief trip to see my aged mother.
Yes.
In her nursing home in Nashville. Yes. Well, I was using aged because of from
because we're already elderly. You don't want to hurt my feelings.
We are old, so I'm going to be away for a few days from the program.
Please call next week. I'll be here all by myself.
And that number to call on Saturdays is
855-935.
Oh, let's let him practice. Yeah, go ahead. Give out the number.
855-935-8255.
And what does that spell in letters?
Talk.
Talk is
talk one for the man.
Talk is one of those weird words. The English language is a wacky language. I mean, talk should be like TOK.
Yeah,
really?
It'd be so much easier.
Think? Wouldn't it be easier
right?
if we just said if we just spelled it TOK, like though, THO.
Yeah.
That's what it should.
What's with the rest of that stuff?
What is
Get rid of
the
that.
U and the G and the H?
Yeah, really hard to do.
Thru, THRU. Can we change
I'm
the
so
language?
Glad you're fixing these things for us.
I'm trying really hard. Anyway,
you have a good trip. I'm
just
saying, you have a good trip.
Thanks.
Things will be taken care of.
I appreciate it.
Don't
Thank
worry.
you.
Yeah.
And send your questions in otherwise at talkingrealmoney.com on the contact form. And honestly, if you need some help and you don't want to get a sales pitch, then you do it through us, not somebody else. Do it through one of our advisors at Apello Wealth. Just go to talkingrealmoney.com and then click on that little button that says Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.